Hello everyone, welcome back to another video. If you're new to this channel, my name is Farhan and I help accounting students like you ace their exams. In today's question, you will learn to interpret the ledger accounts for the sales revenue account and the sales returns account. We will also understand how to calculate the trade receivables collection period and compare the results between multiple years and evaluate whether the business is efficient in tracking its trade receivables or not. You can see the question on the left hand side of your screen, and on the right hand side we've got all the workings which I'll go through and explain to you step by step. With that being said, let's begin. The following information was provided by Revine Pte Limited. We are given the trade receivables and the allowance for impairment of trade receivables for 3 different financial years ending 2021, 2022 and 2023. So what do we understand by allowance for impairment of trade receivables? It is a contra asset account which records the reduction in balance for a relevant asset account, and the relevant asset account in this case is the trade receivables account. This also means that whatever amounts we expect to not collect from our credit customers, that total is kept aside in an account which is known as the allowance for impairment of trade receivables account. All right, and because it is a separate account which records the possible reduction for the asset account trade receivables, it is classified as a contra asset account, which means always that by default it should have a credit opening balance, which also means that when it increases we credit it and when it decreases we debit it. Now let's answer the questions in part A. Interpret the entries on the following dates. Now we have been given two ledger accounts for sales revenue and sales returns. And we have multiple years and multiple transactions in each of these accounts. So when you go through these accounts carefully, make sure to remain focused and pick the correct information. So we start by interpreting the entry on the 6th of December 2021. So on the 6th of December 2021, within the sales revenue account, we have got funds coming in. That's $35,550. So how should we journalize this transaction on the 6th of December? So on the 6th of December, we are debiting the cash at bank account by $35,550, and we are crediting the sales revenue account by $35,550. That is why the sales revenue ledger account is being credited at that point in time. This clearly indicates that a cash sale of goods for $35,550 has been made. Okay? So you can just simply write cash sales of goods for $35,550. The next question is to interpret the transaction on the 22nd of May 2022. So on the 22nd of May 2022, trade receivables of $59,000 have been credited in the sales revenue account. What does this mean? This means that we have sold $59,000 worth of inventory on credit. So now we have got credit customers. So that is simply what we write. The business sold $59,000 worth of inventory on credit. Okay? Now the next date is 31st of August 2022. So on the 31st of August 2022, we are essentially closing our revenue account and transferring the balance to the income summary account, as you can see here, 31st of August 2022. So the total amount that is being transferred is $450,550. You can only transfer this amount to the income summary if this revenue is actually earned, right? So what we write when we want to interpret is that the sales revenue earned for the period ending 31st of August 2022 is $450,550. This amount was transferred to income summary account, which means that essentially when you prepare the statement of financial performance or the income statement, you will show the amount for sales revenue at the beginning, and that is going to be $450,550. The last date to interpret is the 27th of June 2023. Now, if you check the sales revenue account, we don't really have a 27th of June specifically. But in the sales returns account, we do have 27th of June, 2023. And at the beginning, what's happening is that the sales returns account is being debited because one of the credit customers has returned $14,000 worth of inventory for a past transaction that we have done with this guy. So what to write as part of your interpretation? You just simply write that a credit customer returned $14,000 worth of inventory. That's it. And that's how you simply get full marks. Let's solve part B. Calculate the trade receivables collection period for the years ended 31 August 2022 and 31 August 2023 and show your answer to 2 decimal places. Now, the formula for the trade receivables collection period is simply the average net trade receivables, all right? So the average net trade receivables divided by the net credit sales. Now, the key words here in this question are average and net, all right? So let me just highlight this too, average and net. So you can see I've already made a mistake here in the numerator as part of my calculation where I took the gross amount of 33,000 and 39,000, which are given here at the beginning. But we should actually take the average net amount. So what actually needed to be done is that I'll erase this, the gross amount, and I'll replace it with the average net trade receivables that we had at 31st August 2021 and 31st of August 2022. And because we're finding the average, you are dividing the total of 27K and 30K by 2, all right? Now, the denominator is where we record the net credit sales. Again, the key word is net and also credit. So how can we identify which sales are in fact on credit? So you check the sales revenue account, and any amount that is recorded on the credit column is obviously referring to a sale that you have made, either for cash or on credit. If the sale was done for cash, then the particulars column, which is the account that is being cross-referenced, the cash word will be mentioned, like it's being mentioned here, for 6th of December 2021. But anything that is not cash, but done on credit, it's going to be cross-referenced in the particulars column as the trade receivables, who are also the credit customers of the business. So we are first finding the ratio at 31 August 2022. So what we will do is look for all transactions where the word trade receivables is mentioned in between 2021 and 31st of August 2022. So the first one is here, 340K. In 2021, then in 2022 we have got 16K, and then we have got 59K, right? And we are looking for everything until the end of 31st of August 2022 because the business we are working with has a financial year that ends on 31st of August 2022. So up and until the point 31st of August 2022, we have got 3 transactions that were done on credit. 340K, 16K, and 15K. So we're adding these 3 together. And lastly, whatever you have got here in the fraction, we need to multiply it by 365 because we want to express our final answer in days because we are looking at the collection period. It means how long it takes for us to collect the cash that our credit customers owe us. So once you insert these numbers correctly in your calculator, you should get 25.07 days in 2 decimal places for the trade receivables collection period ending 31 August 2022. All right? Now that we have done this, let's move to 31 August 2023. So when we're in 31 August 2023, obviously we have got the numerator at the denominator. So in the numerator, we have got the average net trade receivables, right? So here I've done a mistake again by taking the gross amount from 2022 and 2023. But what we need to do now is just simply replace it with the net amount after the allowance has been deducted, which is 30,000 and 29,000. As you can see, I am circling here on the question, right? And then the denominator, which is the net credit sales. So we're looking specifically for transactions done on credit from 1 September 2022 until the end of 31 of August 2023. So in this period, you would see that the first credit sale was here, 218,000 on September 28. Then in 2023, we have done another credit sale of 621,000. So these are the first two numbers that are being added here, 218 plus 621. And then we ended up subtracting 14,000, which is the sales returns. And we subtracted 14K because the credit customer who returned us $14,000, it is a credit sale at the end of the day. So that should reduce our net sales, right? So that is why it clearly mentions net and credit at the same time. So we have to be aware that the returns have always been subtracted. So once you have your fraction ready, you multiply it by 365 to convert it into days, obviously, and that gives us 13.05 days. All right, so now let's look into part C. Evaluate the management of trade receivables by Revine Pte Limited over the 2 years ended 31 August 2022 and 31 August 2023. All right, so we can clearly see that the trade receivables collection period decreased from 25.07 days in 2022 to 13.05 days in 2023. And is it a good thing, though, the fact that it has decreased? Of course, because as a business, we are now more efficient and have increased the speed of collecting our cash from our credit customers. So what happens is that when you're running your own business, you're able to have more cash on hand to invest in your working capital and your operations and help you thrive and also make more money. Therefore, the fact that the collection period has decreased is a good thing for the business because we have increased our efficiency by speeding up our cash collection. So that is exactly what you write as part of your evaluation. All right? Okay. So I believe you found value in this content. Make sure to drop a like and subscribe to this channel. And check out my other videos. And if you're interested in your course to help you prepare for your exams next year, make sure to check the link in the description below. And I'll see you in the next lesson.